Good afternoon, everyone. It's really pleasing to be here at an in-person event after 2 years in the online wilderness. It is really good to see so many familiar faces. Before I start, I'd just like to thank you for your ongoing trust and support. It hasn't been an easy time in markets the last couple of years. But despite the market drawdowns, I think investors are arguably in a better position today than they were this time last year. And hopefully the presentations give you some comfort to stay invested. So for those of you who don't know me, my name is Paul Kluwer. I'm Managing Director at Foord. I'm joined again by investment professional Nick Curtin and Foord's Head of Private Client Investing, Mike Townsend. So after me, Nick is going to talk about the macro investing environment. He's going to use the MICE framework, that's mice as in rats and mice, to take you through what might be in store and certainly how the world has got to where it is, and contextualize what has driven financial markets into bear market territory this year. And then Mike is going to talk about investment strategies to manage risk and to produce long-term inflation-beating returns. Because for the first time in decades, developed market inflation is back. Even though, as they say in the Vodacom advert, we've been having it here in South Africa. I'm also joined by a number of Foord colleagues. We're all in what I'm told is a Nachi name bag, so please approach any of us with your questions at the break, and we'll be very happy to assist. Now, before we get to the meat of the presentations, I thought I'd start with some anniversaries, some staff appointments, and some exciting new fund launches. So last year, we mentioned that Foord had turned 40, and what a major milestone that was. This year, our flagship global product, in which many of you invested, the Foord International Fund, turned 25 in March. And then the familiar Foord Equity and Foord Balance funds turned 20 at the end of August. Now, I'm told that some of the very earliest investors in those funds are still invested. So if they are you, please let me know at the break, and I'll make sure to order some champagne. So if you've been reading the newsletters, you'll know that portfolio manager William Fraser gave notice of his intention to retire last year, and after 17 years, he is now spending more time on himself and his family. He stays as a director of the company in a non-executive director capacity, but we needed to recruit externally to replace his macro strategy and fixed income skill set. And in the event, we were able to secure the appointment of Rashad Tayob, who had left ABAX Investments early last year after a very long tenure there. He's very well regarded in the investment community, and we're very pleased to have him on board. But he had aspirations to add value beyond just the macro strategy and fixed income research. He wanted to again manage unit trust products in the fixed income space, and that was a first for Foord, but we have supported him in this. And he handpicked the equally experienced Fazana Bayat to help him co-manage those products, and together they make a very formidable fixed income team. And so last month, we launched 2 unit trust funds in the fixed income space. They are the Foord Flex Income Fund and the Foord Bond Fund. Both of them are available for direct investors right now. So let's have a closer look. Okay, the Foord Flex Income Fund is a fund which, as the name suggests, is focused on delivering a high income yield. It does have prospects of earning some capital gains over time, and it has a very low chance of loss over the investment horizon of 1 to 2 years. The fund invests in a dynamic mix of listed and unlisted interest-bearing instruments, but it can also invest into shares and listed properties, but in very small amounts. Now, that fund does invest in foreign securities, such as those priced in US dollars, but the managers typically hedge out the volatile currency risk to deliver a smoother return profile for investors. So what can you expect? Firstly, it is a low-risk fund, maybe just 2 notches above a money market fund. And if you invest for 6 months or more, the chance of a price decline is actually quite remote. But because of the types of instruments that the fund is able to hold, especially with regards to the duration, the term to maturity of some of these interest-bearing instruments, the fund is likely to deliver an income yield well in excess of money market yields. And right now, the fund is yielding 8.2% per annum, but that is likely to change because a lot of the instruments in the fund have variable rates of interest, so it will move as the yield curve moves. As I said, it's a fairly low-risk fund that's suitable for investors with a short time horizon, while the yield is high, it is taxable for the most part. So I think if your time horizon is longer than 2 years, then there are probably better products within the Foord range that will allow for more capital growth over the period of investment and with a lower tax burden. So I just wanted to say, use this fund with purpose. Please don't try to time markets and sell out of your longer-term investment products, incurring a capital gain. Rather leave that for us to do within the context of the multi-asset portfolios at no extra tax cost. Okay, the second fund is the Foord Bond Fund. This is a specialist fund that invests in a wide array of South African bond assets. At 10.8%, that yield is quite a little bit higher than the Foord Flex Income Fund, but the fund comes with more risk of loss in the medium term. And so while bonds deserve a place in most investment portfolios, at least most of the time, we would suggest that you seek financial advice before including this in your portfolios in significant or meaningful amounts. Now, both of these funds should beat inflation over long periods, but not by the amounts needed to really compound meaningful inflation-beating returns over time. For that, you're going to need to have growth assets in your portfolio to do the heavy lifting on the inflation front. And this is a theme that Mike is going to talk to later today. Okay, so while we're on inflation, you might recall that last year we had flagged rising inflation as one of the principal threats to investment outcomes. And even long before Russia invaded Ukraine, we were worried that the inflation pressures were building in the global system, and that central banks weren't doing enough, or anything in fact, to raise interest rates to combat that inflation or to withdraw past money supply. And I think I'll repeat what I said last year, that across the decades it is inflation, not market drawdowns, not recession, it is inflation that is the biggest destroyer of capital. And right now, I think the South African inflation rate is about 7.5%, certainly on the official side. It's closer to 8 in the US, while in the UK and the Eurozone, it's in the double digits. And I think I read yesterday that the UK inflation print is now at 11%. So at 10% inflation, the purchasing power of your capital halves in less than 7 years. Just think about that. It halves in less than 7 years at a 10% inflation rate. And I'm still trying to work out whether that makes us half as wealthy or twice as poor, but I guess a little bit of both. Okay, so the central bank response, as we'll show you, to this high inflation around the world was to belatedly increase interest rates this year only, and then to do so at the fastest rate in 40 years, while also starting to withdraw past stimulus from the system. And in a moment, I'll show you exactly what a 4% increase in the US interest rate has had on global markets. They're dramatically lower as a result. And it is the US interest rate that's done all the damage, because in the UK, the BOE has lifted rates by only 3%, while in the Eurozone, the ECB has done so by even less. Now, you might be asking, why do asset prices fall when interest rates go up? And the simple answer is that if you can earn more interest on your dollar cash balances today, then you'll be willing to pay proportionately less for more uncertain income streams in the form of interest on bonds or in the form of dividends on shares that are earned much further into the future. So there's an inverse relationship between interest rates and asset prices, and I guess it's similar to that adage that a bird in the hand is worth 2 in the bush. Although in this case, as we'll see, it's not quite worth twice, but maybe about 20% more. Now, if you can forecast a rising interest rate environment, why continue to be invested in financial securities such as bonds and shares? And that's a very good question. And the answer lies in striking a balance between the short-term effects of asset drawdowns on the one hand, and having enough growth assets in the portfolio to deal with the coming inflation threat in the coming years. And that's the more dangerous of the two. So that is the theme of today's presentation. It's finding the balance between these twin threats. And Nick is going to speak on how the world got into the mess it's in and what might be in store. And then Mike is going to talk to you about how we are managing these twin threats in the portfolio, while also finding some exciting investment prospects from these levels. Okay, let's get on to the asset class returns. I've said that markets have fallen this year. I think global share markets peaked right at the beginning of the year. It was probably about the 3rd of January. So I'm going to show you the asset class returns for the year to date, which I think is appropriate. This is up to the beginning of last week. And then I'm showing you calendar year returns for 2021. That was that big up year when markets rallied to all-time highs on extended COVID stimulus and market reopenings. And then for the calendar year 2020, that was that V-shaped COVID recession and recovery year. And just to note, US markets did have a bounce on Friday when the US inflation print came out just a little bit better than expected. We haven't incorporated it in these numbers. I think at some point we had to cut off somewhere, but also because it doesn't dramatically change the picture. And thirdly, we're not sure that it's sustainable. Okay, so as I mentioned, the US Federal Reserve had been talking about raising interest rates at the beginning of the year. It only did so for the first time in March and then quickly raised the federal funds rate from 0.25% to 4% by the beginning of this month. And this is the impact on asset classes. We can see developed market equities down 20% in US dollars this year. But look there, global bonds, minus 21% in US dollars. Now, a fall of 20% or more is typically regarded as a bear market. And in this case, we can see that the normal diversification benefits between shares and bonds just haven't worked this year. And in fact, I read the other day that a standard 60-40 fund, a fund with 60% in shares, global shares, and 40% in global bonds, has had its worst performance year in 100 years this year. Okay, we can also see that Chinese equities have fallen quite dramatically after being very resilient, quite ironically, in the 2020 COVID year, when it escaped major lockdowns. That country has been engaged in quite severe lockdowns for the last 2 years, as well as there's been some aggressive regulatory interventions in the tech sector, and we've seen that stock market underperform quite heavily. And those factors continued into 2022, and the markets all but capitulated when President Xi consolidated his power base. And surely that market must be in rock bottom. And again, just to note that since these slides were printed in the middle of last week, that Chinese market is up in double digits. And Mike will speak to you a little bit on that as well. The South African share market down just a few percent in rands. It was buoyed by rand weakness, but we can see in dollars down more than 10%. And we can see that the South African market actually outperformed global markets. And why is that? Not because the prospects here are so much better, but because we didn't quite reach the stratospheric heights of global markets, and so we've fallen by less, but from a lower base. The South African bond market has eked out a positive return. Yields are also up here, as Nick will show you. But the high yields on South African bond market have helped cushion those price declines, which wasn't available to global bond markets. And then we can see that most commodities, including gold, were lower on the opportunity cost of rising interest rates, but also fears of slowing growth and even recession. The two exceptions noted here are oil and the US dollar. So while well off its highs of early in the year, oil is still up over 20% this year, and that is causing cost pressures in the global system. And higher US interest rates and a flight to safety meant that the dollar was quite a bit stronger than almost all currencies, including the rand here at 10% to the early last week, and the euro 13%. So we can see that the environment was very negative this year. How have the Foord funds performed in this context? We can see the South African funds all doing really well, quite resilient in the negative market environment. The multi-asset class funds, the Foord Flexible, the Foord Balanced, and the Foord Conservative Fund, they're all variations on a theme, some slightly lower risk than others, but they all performed in the top quartile, so the top 25% of peer group funds this year, which is quite pleasing. But if we had anticipated an environment like this, as I think we largely did, why are our funds not right at the top? And the answer is that the funds that are doing best this year amongst all the peer group funds are funds that have sold down heavily on growth assets, including shares. We have chosen to maintain a fairly high weighting to growth assets to deal with that coming inflation threat, which I said was the more dangerous of the two. And you might be surprised to hear that a fund like the Foord Balance Fund, for example, in terms of regulation and its mandate, can't hold more than 75% in shares. Right now, it's only 65% in shares, so it's not even dramatically lower than its maximum weight. And the Foord Flexible Fund has more than 70% into equities and listed property right now. And again, just to put some context, for those of you who are invested in the Foord Flexible Fund, and I'm sure most of you are, at minus 2.2% this year, to just put that into context, amongst the peer group, the 124 funds that have a similarly wide investment strategy, more than 20 of them are down minus 15% or more. And in fact, the worst performing fund in that category this year is minus 38%. So we think the minus 2.2% is a really credible outcome. This is not a year to be adding, it was not a year to be adding aggressively, seeking return, but we think we're positioned carefully for the coming threats. Okay, the Foord Equity Fund has not been a star performer for the last few years. We were cautious on the global economy, and we were underweight the cyclical resources sector, which had outperformed leading up to 2022. This year, we can see that the fund has shown some outperformance of the peer group and the benchmark, but not as much as we would have hoped or perhaps liked given the stage of the cycle. But it's not over yet, and in fact, we're quite excited for prospects from these levels, especially amongst the small and mid-cap stocks that we favor. Okay, let's turn to the Foord International Funds. If you invested in our global products in US dollars, we can see that the Foord International Fund, the flagship conservative US dollar fund, the one that's just turned 25, it followed a very similar performance pattern in terms of having a very resilient 2020 during the height of the COVID recessions, but thereafter it lagged peer group funds and markets, which rallied to all-time highs by the end of last year, and we were prepared to sit out of that exuberance. This year, however, the minus 3.9% is a standout return, given the opportunity set. Remember, I showed you minus 20% for global share markets, minus 21% for global bond markets. So we think we've done really well to have a minus 3.9% return there, with more than 60% of the fund invested in equities, albeit that we have some hedges against the most expensive markets. And in rands, that fund has delivered more than 7% in the year. Okay, the Foord Global Equity Fund has more Chinese investments than its benchmark. It has a 20 to 25% weight in the region, and we still continue to believe that prospects are better there for growth and the valuations are much more attractive. But we can see that that's been a headwind to performance for the last 2 years, given the performance of the Chinese stock market, which I showed you earlier. Okay, so that's it from me, I think, in terms of the backward-looking part of the presentation. I'm now going to hand over to Nick. He's going to use that MICE framework to contextualize what's been happening in global markets and what might be in store.
It's really nice to see you all again in person in this happy place. At Foord, we like to think in years and comprehend in decades. You will have seen it on the banners in the foyer outside. So my job today is to share some of those thoughts with you, and I'm going to do that by trying to give you a bigger picture view of what's been going on in the world, and more importantly, what we think is coming. So Paul's already taken you through the market falls that we've seen so far this year and how those were really catalyzed by the reappearance of inflation. It's that big bad wolf that appeared to have been asleep for the last sort of 30, 40 years. So what is inflation? There's hundreds of academic definitions and there's thousands of very eloquent quotes around what inflation is. But in the spirit of keeping it simple, stupid, all inflation really is a measure of how the price for goods and services changes over time. It's really that simple. And we really care about inflation because it makes money that's saved today less valuable tomorrow. But as the saying goes, pictures speak 1,000 words. And I think there's enough grey hairs in the room today for a lot of these anecdotes to strike a chord. And it's one of the difficulties in our industry is that you actually need quite a lot of age under the belt to really appreciate the power of inflation. I've tried to explain it to my teenage kids, and they just don't get it, partly because they haven't been alive for long enough, and partly because they've never actually paid for anything with their own money. So I just wanted to spend a second on this last one, which is the fuel price in South Africa between 1970 and 1985. And just looking at the 1985 date, it's amazing to think that petrol cost you R1 a litre. So you could fill a 50-litre tank of petrol for $50, which is an amazing thought. Today, that same 50-litre tank would cost you nearly 1,300 rand to fill up. And I think that's the kind of sneaky nature of inflation. If you annualize it, it's only around 8% per annum, which doesn't sound like a very big number. You think 8%, it's not massive, but compounded over a 37-year period, it has an enormous impact. But what's also interesting is if you took that $50 and instead of putting the petrol in your car, you invested it with Foord in 1985, that same amount would today be worth 28,500 rand. So the power of compounding is exponentially more powerful on your assets than it might be on your cost base if you're buying assets that are going to outperform inflation over the long term. We honestly believe that that's the only way to properly immunize yourself against inflation risk, and it's why we harp on about it every time we see you. But inflation comes up in many different ways. So this is a picture I got from an old varsity friend the other day in a WhatsApp group. It's about 25 years ago. That's me in the corner. And when you look at this picture, the inflation is immediately obvious. But it's also quite interesting how cheap the beers were back then. So you've got to be careful. It sneaks up on you. Nickflation, as Paul likes to call it. Okay, so let's get a little bit of context before we spend a bit more time on what's caused the recent breakout in inflation. So what I'm showing you on this chart is inflation in the United States. So it's simply a year-on-year percentage change in the average price of things in that economy, going back to the 1980s. I've included the back end of the so-called Volcker era, but it's not that relevant for today. You can also ignore the squiggles up and down. They are quite large, but essentially those are just the ebbs and flows of the normal sort of economic cycle. I think the key sort of picture to take out here is that you don't need to be a financial analyst expert to understand that the world's been through a very long period of actually very low inflation by historical standards. And that's quite important to understand, because what that has allowed is that interest rates have been able to consistently fall over a long period of time to lower and lower levels, and then they've kind of stayed there for a long period of time. And that's really important because, as Paul's already shown you in his fulcrum, asset prices really like falling interest rates. And there's some fairly intuitive reasons. One of them is the valuation metric that Paul took you through. But from a fundamental economic point of view, it also makes sense. If you're running a business and you want to grow your business and grow your profits, access to funding is cheaper. You can get debt for a lower cost. You can grow your business, expand your profits. It's good for shareholders, good for earnings. Likewise, if you're an individual, you can borrow at lower costs to buy a house, to buy a car, to buy all that stuff that you put in houses and spend on holidays and services. So you get this kind of virtuous circle that takes place. So that's been a really important driver over that time period. Just to point out, this inflation chart only goes up to around the beginning of last year. So I've cut it off before the recent outbreak, which we're going to have a closer look at now. So this is the same data. It's inflation in the US, but I've taken it from the global financial crisis period, which was arguably the last sort of major inflection point in global markets. And I've run that up to the current dates, the end of October. And I've averaged the period from 2008 until the recent breakout sort of towards the end of last year. And it's not to do any smoke and mirrors. It's just to make that inflection point a little bit easier to see. So I think the high was around 2.5% back here somewhere, and it got as low as 0. But I think the point is made that we've been through a very long period of very low inflation. And what happened more recently, and you just see the scale here, is this enormous breakout in inflation in the US and across the entire world, besides perhaps Japan, which is a whole other subject. So if you go back to the beginning of this year, kind of January, February, March, this is what markets were reacting to, this kind of inflation shock. And the reason that asset prices reacted the way they did, again, is because rising inflation typically means that there are higher interest rates coming down the line, which is exactly what's played out. So let's have a look at the South African experience. So we've also seen a sharp inflation breakout over this time period. But I think the other point I wanted to make, which is probably more important, is how we're a structurally higher inflation economy. So over that same time period, and I haven't averaged it here, but you can see we've never got down to those ultra-low levels of inflation and as a consequence, ultra-low interest rates that you've seen in large parts of the world. And that's important because it means we haven't landed up in this place where we've had these really distorted asset price valuations as a consequence. And that's partly, it's going to be an important comment thought to bear in mind when Mike takes you through the positioning and the valuations going forward from this point. So we've also had a bit of pain in this country, but it's on a relative basis has not been as bad as most parts in the developed world because we've always been at a structurally kind of higher level. And we think we're pretty much near a peak, and we expect that to roll back down to a sort of more manageable level. So South Africans are old friends with inflation. And we've become quite good at living with it and managing it. Okay, so what's caused this inflation breakout? So most of the politicians and certainly the central banks in the world would like to lay the blame entirely on recent events. The obvious ones being the COVID-19 pandemic lockdown era, and then more recently the Russian invasion of Ukraine. And they certainly do shoulder a lot of the blame, certainly as a catalyst. We all experienced it through the lockdown period. We were sort of jailed and couldn't do anything, and they kind of let us out of jail, and we all wanted to get out there, go shopping, go traveling, and get back to normal life. So you had this enormous spike in demand across the world's economy. But of course, the supply side takes a lot longer to come online. That thing you buy at Builder's Warehouse down the road is not made in a factory down the road. It comes from a factory in China and goes on a truck to the port, gets on a ship. Ship goes across the world, comes into another port, goes on another truck. And so it goes. So across the economy, those supply lines took a lot longer to come back online than the demand for them did. So you get this economics 101, very sharp rise in demand and a much slower response in supply, and that created a lot of inflationary pressure on the average price of goods and services, at the risk of oversimplifying. And then more recently, the Russian invasion of Ukraine has also kind of poured fuel on the flames, so to speak, pun fully intended. And that's simply because Russia, firstly, is a major exporter of energy, in particular into Europe. And in fact, both countries together are major producers of grains, which is a critical component to world food supply. So the breakout of hostilities in that region resulted in a real sort of shock in terms of prices for energy and food generally. And those are both quite strong inflationary drivers. So that certainly has happened. But we think there are much deeper underlying drivers of what we're seeing in the world today, and arguably what's likely to persist for a longer period of time, because the previous two should fade as those kind of base effects come out of the system. And the first of those is this extraordinary period of low interest rates that we've been through. So these are the lowest interest rates. Again, this is just a US interest rate. I've done the same technique, averaging since 2008. There has been an up and down, but I'm just trying to make the message a little bit clearer. And it's essentially the lowest. I think some of the studies have shown it to be the lowest in something like 5,000 years. How credible those studies are, I don't know, but they certainly can't be far off. And that's been a really critical. The astute amongst you might realize that average was 0.5. The inflation average was 1.5. So from a sort of after-inflation point of view, interest rates have been negative in real terms for a long period of time. And the other point to make over here is that central banks have been very, very late to cotton onto that. So they were very late to start raising rates. I think we told you before in previous sessions that we thought they were making a policy error, and then they've played this massive sort of catch-up. And that's partly, if you think about the second part of the second quarter of this year, sort of April, May, June, so the world now's got a shock around inflation, and then interest rates started to rise. It's amazing that they only started to react in around March of this year, and that was a kind of interest rate shock into the markets. Wow, we're into a different inflation era, and you've seen an asset price response. So some interesting observations as well. When you have a long period of very low inflation like that, it's almost guaranteed to create inflation at some point down the line. You just kind of need the catalyst. You need somebody to spark the match. But it also results in a lot of speculative financial market behavior. So it's kind of no surprise that during this period we've seen the likes of cryptocurrency and Bitcoin and NFTs coming onto the scene, some extreme valuations in the technology space. As well. So I think Paul took you through the anecdote earlier, the sort of relative value thing. If you're getting 0 or -1 in a bank account, it's a lot easier to throw that money at another asset in the hope that it goes up because your opportunity cost is so low. So a lot of these things are starting to play out in more recent times. So markets are pricing interest rates in the US to head up to around 5%, starting to drift a little bit lower. We think they probably don't get there, maybe up to sort of 4.5%. because the thing with rising interest rates is that they take a little bit of time to actually filter into the real economy. So those examples I gave you earlier, it takes a while for the debt to be refinanced, for the actual economic effects of it to start to bite. And we haven't really seen that take place yet. So these are the fastest rate rises we've seen in more than 40 years. So it's a significant event. But there's another key underlying driver, and that's this record amount of stimulus that we've seen across the world in the last sort of 10 to 15 years, mostly coming out of the global financial crisis period. And this is in addition to lower interest rates. So this is central banks doing, whatever. There's a whole lot of acronyms that they use for it: open market activities, quantitative easing. You've probably heard all these sayings in the press over that time period. And more recently, actual fiscal stimulus, which is literally governments sort of sending support checks in the mail to help people through the COVID period. The details of it are less relevant. I think what matters is the quantum. So if you sum all of that up, it's something like $30 trillion of stimulus that has flowed into the global economy, and a lot of that's gone into financial assets over that time period, which is just an enormous number. So, trillions, they kind of roll off the tongue, and it reminds me of toddlers who talk about bajillions and gazillions, and it's kind of hard to get your head around what a trillion actually is. So I thought I'd give you some pictures to try and bring that home. So if you take $100 bills and you pile them up tightly in little stacks, $100 million would fit onto roughly a standard-sized pallet and sort of just over waist high. So to give you some sort of sense, that would be $100 million. To get from there to $1 billion, you'd need 10 of those, okay, which is 9 zeros. That would be $1 billion. To get to $1 trillion, you need 1,000 of those. Okay, and you'll notice that the pallets are now double stacked, and there's the little guy standing in the corner just to give you some scale effect. And we're talking about 30 of these. Okay, so it's a large number. It's just we sort of hear these numbers and we speak about them, but we don't really comprehend the size. I think it's something like $6 or $7 billion a day on average over 14 years, essentially of money coming into the system. The details and technicalities of it are less relevant, but that's clearly had a supporting effect of financial markets, and more recently has had quite a strong inflationary driver. So this is a prime culprit. So the plug has been pulled. Liquidity is starting to go the other way, so they're starting to drain it out, but clearly that's going to take a very long time. And to some extent, that creates a little bit of a headwind for markets going forward. Okay, so what does all that mean? I've given you a sense of what's happened to inflation. Interest rates have followed. Where does that go from here? I think I've given you some indication that it looks like inflation, certainly in the US, has started to roll over. There was a slightly lower than expected print last week, and markets got very excited about that, amazingly, extremely excited, which is probably not a good thing. But they're either at or very near a peak, and we would expect that interest rates are probably not that far behind. So there's a lot of that kind of action has already happened. It's behind us. And we've probably got a little bit further to go, but then we start rolling over into the sort of other side of the valley, so to speak. And that's quite important in terms of what that means for markets going forward. South Africa, a very similar experience. So Paul mentioned we're up at around 7.5% inflation. We expect that to start drifting down to 5%. We've probably got another 1 to 1.5% interest rate rises to come. Markets are pricing a little bit more than that. We think we probably don't get quite that far, and then we start to kind of drift down on the other side. And the reason I'm pointing that out will become clearer in a moment. So one of the other currents in the oceans that it's very important for us to take measure of is this concept of confidence. So it's almost the kind of animal spirits. It's the bit that you can't really quantify on a spreadsheet or measure. It's the mood. Are people optimistic? Are investors pessimistic? Are they bullish, bearish? Pick whatever word you'd like to use. So it's trying to get a sense of which way the wind is blowing. And I'm not going to go through all of these, but we all know, if anybody of us, we all spend too much time reading the news and listening to stuff, and we get bombarded with it all day long. There's no shortage of things to worry about at the moment. As far as your savings go, these are the things that we worry about so that you don't have to. So if you have to get your news from anywhere, try to get it from us. We'll tell you the stuff that's worth knowing about. Other than that, try and avoid the newspapers. And then the last big picture I wanted to leave you with is earnings, so which is just a kind of fancy word for, I guess, profitability of companies. So this is just an average earnings measure of equities as represented by the global index, and it's after inflation. And it's a relatively simple slide. Essentially, that sort of dotted red line is the long-term trend through time, and as you'd expect, it's kind of growing more or less in line with sort of your average economic growth over time, which is intuitive. But clearly there's cycles to it, and that's, most people in this room will understand there's a natural kind of business cycle. There are times where things are tough, times when it's boom times, and your sort of profit cycles move in sync with that. So let's just try and get a sense of where things are on average at the moment, and earnings seem to be at a reasonably sort of high base. So we've seen the inflation shock, we've seen an interest rate shock, but we haven't really seen the consequence of that in the real economy, and by extension what that means for company profits and earnings for shareholders going forward. And we think that's where a lot of the uncertainty is, and we'll kind of see how that plays out going forward. So I use the word average on purpose, because again, this is a global average, but we don't invest in averages. The old joke about average, if you put your head in the freezer and your feet in the oven, on average you're the perfect temperature. There certainly are a lot of opportunities. We'll be very excited about the earnings growth from this point, and they're at very attractive valuations, and that's a big part of what Mike's going to talk to you about going forward. Okay, so there's quite a lot of ground that I've covered, and Paul mentioned the MICE framework. If you remember nothing else from the short talk that I've given, just remember the MICE. So the M stands for money for the markets. Remember the $30 trillion, the kind of liquidity is money coming into the system or coming out. It's starting to come out. We've had this massive tailwind for a long period of time. That liquidity is starting to go the other way. Interest rates, again, asset prices like falling interest rates. They don't like rising interest rates, but a lot of that rate rise is now behind us. So we're getting closer to that peak. So I guess that's a kind of half tick, half cross. There's still some more pain to come, but we're near the top. Confidence is not amazing at the moment. It's a bit of a mixed bag, but it's also a bit of a double-edged sword, because very often when markets are the most kind of pessimistic is quite often your sort of maximum opportunity point. So just because things are gloomy, that's very often the time where you'll find us most optimistic or most bullish. And then earnings, as I've said, on average are relatively high, but the price that the world is paying for those earnings is certainly a lot lower than it was. And there are certainly opportunities within that underlying that we think are pretty exciting from this point on, and Mark's going to cover more of that in a moment. So the MICE as a scorecard for markets is a bit of a mixed bag, but it's certainly improving from where we were this time last year. And that's the last point I want to leave you with. If you think about market psychology, we've talked about the inflation shock, we've talked about an interest rate shock. None of these things had started to happen when we saw you this time last year. They were things we were talking about as risks that we were very concerned about, and we're exactly why we were positioned relatively cautiously and defensively. The good news now is that we're through those inflection points. The kind of inflation shock is kind of old news in terms of market psychology. The interest rate rises that have followed it are also relatively old news. We're near the top of that cycle. Where the world is spending most of its time worrying at the moment, if you think about the market as some kind of singular entity, is really around growth. So the effect that those rising interest rates are going to have on the real economy, do we get a recession? If so, how soon? How deep does it go? That's kind of where most of the uncertainty and discussion and debate is at the moment. But I guess the good news is that two of these three things are comfortably behind us with sort of one to go, and compared to where we were a year ago, that makes us a lot more confident about the returns we can generate for you going forward. And Mike's going to show you why. Thank you.
Hello, ladies and gentlemen. It's lovely to be here again and see so many familiar faces. And it's a lot better seeing real faces than just looking at that blinking light as we've done the last 2 years for the online presentations. A common theme that we've spoken about at Foord in the past has been our safety-first approach. Our first priority is to not lose money for you, our investors. And the second important thing is that over the long term, we've got to generate real returns for you. So I'm just going to start my part of the presentation by just revisiting a slide that we used last year, just to go through what was keeping us awake at that point of time. And as we discussed, valuations were very expensive. Inflation was something that we were a bit fearful about. There was a lot of geopolitical risk around the world, and that certainly has come home to hit us in a big way. The local economy was stagnant, and we know all the issues with Eskom and lack of government delivery and all these things that we can talk about for a long period of time. But it was going to be a difficult environment to protect and grow Rand savings in real terms. And I think, as Paul showed you earlier, certainly in the multi-asset class funds, we have protected your savings reasonably well over this last year. So now let's look forward and see what we're worrying about at the moment. And unfortunately, a lot of those things are still with us. And sleep deprivation is becoming part of our job description, I think. So how are we going to generate these real returns going forward? Inflation is still here. Nick discussed that in detail. Interest rates are a lot higher. And that is going to impact the economy, as he mentioned. So our credit card debt, our bond repayments are all going to rise up, which means that we've got less money to spend, we buy less volume, we might stop buying at Woolies and go to Pick n Pay or Checkers or whatever it might be, but we spend less. And likewise, corporates are not seeing that volume growth, so they don't put up the new factory, they don't expand their operations, and general economic activity sort of slows down. And that brings us into a recession, which we fear is coming, but we're just not sure how deep that recession is likely to be. And there are a lot of risks around at the moment. I mean, the Ukrainian war is continuing. The COVID, we're not sure how China is going to deal with COVID going forward. They seem to be easing a little bit, and that has a big impact on all our markets, particularly the resources sector here in South Africa. How high are interest rates going to go, and how deep is the recession going to be? So, what asset classes perform in this environment, and how are we positioning your investments to generate those real returns? I think the easiest one to deal with is bonds. And this bar chart just shows you the inflation rates on the far left-hand side for the US. We think it's going to average 5.5% over the next year. A US long bond is giving you 4% at the moment, and cash at the bank is less than that. So you don't want to be in bonds and have your deposits in the bank at the moment in the US because you will be losing money in real terms. And what's the position in South Africa? Here we're looking a little bit better. So inflation rates we think is going to be a little bit higher. It's averaging 6% over the next year. You can buy a 10-year bond for around 11% at the moment, a little bit low after this last week. And you can get a positive real return in cash at the bank. So we do have some domestic bonds in our multi-asset class funds, and those are generating a real return. But the area where we feel you can get the better longer-term returns is in equities. And so let me just spend a bit of time explaining why. And this chart here is the S&P 500, the biggest market in the United States, and it's the total return. In other words, including the dividends that you've received over this 25-year period, and I've compared it to their long bonds, including the interest that you would have received. And what's clearly evident is that over the long term, equities outperform bonds, and they've certainly done a lot better than inflation. There are periods, obviously, the Y2K crash, the global financial crisis, that short, sharp dip that we had in COVID, where equities don't perform, but look how quickly and strongly the market tends to recover from those, we call them drawdowns, those dips. And then just before I go on to the next slide, just notice this more recent 20% fall that we've had on the S&P 500, which you might think presents a great buying opportunity. But I think this next slide just dispels that to a certain extent. And this is the S&P 500 again, over just the last 5 years. That 20% drawdown is more clear on this. But what I've superimposed on that is what we call the PE band. So that's the share price divided by the earnings of a company. So it basically gives you an idea of how expensive a market is. So above the line, that gray line is expensive, and below is cheap. So right now, the S&P 500 is on a 16.5 P multiple, which is close to its long-term average. But given all those risks that I mentioned earlier, you could say that that's not discounting all the risks adequately. And that's our feeling. But within that, we're seeing quite a bifurcated market. So you're seeing companies that have really sold off heavily, that are giving you the valuations are so cheap that they're providing downside protection. It doesn't look like they can drop much more. And we also look for those companies that have pricing power, that are able to push up prices in this inflationary environment. And we're finding a lot of businesses like that. Just to give one or two examples, there's a company called Nutrien. It's the biggest supplier of potash in the world. So that feeds into the agricultural sector, which should benefit from the very high grain prices that we have at the moment. And likewise, FMC, which is one of the world's largest crop protection suppliers. So those sorts of companies we feel should do well in this environment. And then the tech sector has sold off heavily, and we're seeing opportunities there too. We've also spoken in the past about China, and Paul alluded to it earlier. That market also has got a lot of opportunity, especially given that the whack that it's taken over the last year and a half. And I'd like to just spend a bit more detail on this. So what the bar charts on the left-hand side show is that in the Asia-Pacific area, roughly 28% of the middle class was in that area back in 2009. And that's grown to over 50% in 2020, and the expectation is that they are going to represent close to 2/3 of the global middle class by 2030. It's just 8 years away. And so this middle class, they have rising incomes, and they're going to start spending more. So we have been looking for businesses that benefit from that, and there are a couple of those on the right-hand side. So in the tech sector, there's JD.com, Tencent, Alibaba Group, and JD and Alibaba are actually up 40% this month alone. They're still 20% down for the year because that market sold off so heavily, but they've bounced up very strongly as investors realized the opportunity set that was just too cheap to overlook. Then with all that consumer middle class spending more, the consumer sector should benefit. So the WH Group, AIA is a life insurance company, and people will be buying more life insurance going forward. And then that last one, H&H stands for Health and Happiness Group. I think any portfolio must have a company with that name in it. Just must do well. So we don't invest in China. We invest in a few good quality Chinese companies which we feel are going to benefit going forward. They've got pricing power, they're looking cheap, and they should add value to the portfolio, which they certainly have done over the last 2 weeks. Okay, so let's move to the local market and stick with that equity theme. And yes, there are a lot of problems. Eskom is having a real impact on the economy. Businesses are starting to report, and we've had a number of companies reporting this last week. Electricity curtailments are increasing their costs, it's impacting their production, and it's affecting their earnings, which drives share prices in the long term. We've got local government delivery, which is also a hindrance. And then the resources sector, which we spoke about last year, which has been giving the economy a boost. Now, iron ore prices, the rhodium price, the coal price, they're all down by 20%. So the earnings of those companies is coming down. So it sounds negative, but we are seeing wonderful opportunities. And I think this chart, which again shows the price to earnings multiple of the JSE, our local stock market, you can see it's currently at 11 times. So I think two things are important here. One, that's a significant discount to the S&P 500, which was 16 to 17 times, and it's the second cheapest that it's been over the last 20 years. So there are good opportunities in the local market, which we have in our portfolios. And let me give you a couple of examples there. So we like the healthcare sector, the banks are looking cheap, consumer and the industrial space. And here are some of the names. Surprisingly, the hospitals really struggled over this period because COVID beds weren't as lucrative as ordinary critical care and emergency surgery type bed nights. So that the hospital suffered over that period, and we feel that's going to come back. So people who might have had elective surgery for a hip replacement, like my mother-in-law, she's put it off, and she's going to have that at some stage, and it is and the hospitals will benefit from that. So the healthcare sector, the current earnings this week, Life Healthcare reported, and there were one or two funny things in it, but we feel going forward, the earnings should grow strongly. Likewise, our South African banks are very well capitalized. They on dividend yields of 67%, the PE ratios are 67 times. We think that's very good value, and they benefit from higher interest rates, actually. The consumer space is also going to be under a bit of pressure with people spending less. Not sure how long government grants are going to go on, but we're finding these good quality companies at low multiples that we feel can deliver going forward. And then the industrial side, Bidvest, Omnia, Metair. And I'd just like to point out, before I move into the next slide, just notice how many small cap companies there are here. So Metair, Omnia, Italtal, the great, they own ceramics, and they've got Taltoria, Italtal stores, and then you've got Life, which is a mid-cap company, and PSG. And given our size at Foord and the assets under management, we feel that we can be a lot more nimble and agile in finding these opportunities and investing in these less liquid small cap companies that many of the really big fund managers are unable to do. And I think that's captured quite well in this slide, which shows you the performance in black of the small cap sector against the overall market just over the last 2 years. And I've based both of them to 100, and you can see there's been clear outperformance by the small cap sector. And our good representation of those shares in our portfolios have certainly helped more recently. It's not only what you have in the portfolio, it's also what you don't have that can potentially hurt the portfolio. And the precious metal sector is one that we've had a very low exposure to over the last 2 years. That's the gold and the platinum companies. And you can see that's the black line here. And they've not only been a lot more volatile than the overall market over the last 2 years, but they've also not performed as well as the overall market. And although we don't hold much in the way of these shares, we certainly do have gold, the metal, in our portfolios. And this next slide actually just shows you how well gold has done over the last 10-year period. And gold this year is actually positive. When the shares have declined this year. And gold always has a good insurance value in a portfolio and tends to do well when geopolitical risk is high, which it has been most certainly over the last year and continues to be high. So I'll show you shortly, but we certainly have a nice weighting to gold as an insurance mechanism in our portfolios. So I'm coming to the end now. There are a lot of risks in our market. There are a number of probable scenarios. We don't just bet on one outcome. Safety first is our mantra. We do expect inflation to persist. Interest rates are going to be higher. We have got selective bond exposure, which I'll show you shortly. Gold maintains its safe haven appeal in a portfolio. And yes, there is likely going to be a recession. There are a lot of unknowns, but growth rates are moderating, but there are equities provide that pricing power and should deliver real returns if you choose the right ones. And particularly within the China and domestically, we're seeing quite good opportunities. So I'm going to finish off now by this last slide, which is just our Foord Flexible Fund. And I'm just going to talk about our asset allocation because I think that gives you an idea. This is our best investment view and where we would recommend most investors over the long term should have a decent exposure to this fund, which is where most of us in Foord do put our savings. So first of all, equities is 74%, roughly split between South Africa and internationally. And I just want to point out that roughly 12% of this is look-through basis is in Chinese shares, which have done particularly well over the last 2 weeks. And the second important thing is that 56% of this total fund is invested offshore. The rand has strengthened from 1840 to 1720, but don't be deluded by that. It may strengthen a little bit more, but over the longer term, we feel the rand is likely to be a structurally weakening currency. And so you must have a decent weight of your portfolio offshore. We've got the commodities, that's the gold exposure at 5%, some bond exposure, predominantly here in South Africa. And then you might also ask about that cash. Why have we got 12% in cash when you're not getting a real return on that chunk of the portfolio? And this is an insurance policy. So we might be wrong on our view that equities, they might not perform as expected, or there might be a little bit of a further decline in equities. We've had a strong bounce, and often after this, you get a bit of a drawdown again. So it's a bit of an insurance policy, and then it also gives us the flexibility to move quickly, to invest that money in those great new opportunities that might come up. So We feel confident that we can generate real returns from this level. We have got great equities in our portfolios, better quality equities than we've had for a while, and we're expecting decent real returns over the medium term from our portfolios. So thank you. I'll just hand over to Paul to finish off.
All right, thank you to our speakers, and thank you to you for your presence here today. Thank you for attending. You heard today that the environment that we were anticipating last year has largely come to pass. Although, of course, we couldn't forecast that Russia would invade Ukraine, nor that Chinese lockdowns might continue to the extent that they have. But the portfolios were generally cautiously positioned to mitigate against losses from a variety of sources from whatever direction. But we still have adequate growth assets in the portfolios to deal with that coming inflation threat, which we regard so highly. I'll repeat what I said at the beginning of the session, is that investors are arguably better positioned today than they were this time last year on a forward-looking basis. We have warned that inflation might be sticky, and there's rising recession risks. But as Mike showed you, there are some exciting opportunities in South Africa and abroad from these levels, and the portfolios have ample liquidity to capitalize on those opportunities.